So obviously, I'm not going to talk about any decent content because you don't want that. But I do have three people to join me to actually talk through alternatives, and particularly around thinking about how we can solve the issue that Michael and Jason have spoken to around how do we get more alts in platform land. So I've got three people, as I say. First up, Kieran. Kieran's CIO at Centric, and so obviously as a licensee supports both retail and wholesale investors. I've got Alex, who's the PM at Russell, and Alex is going to help us solve some of that alternatives into the retail space shortly on North. And then finally, we've got Stuart Eliot, fan of debasement as well, but he looks after the portfolio design at AMP Investments, so both our funds and managed portfolios. So obviously, we've spoken a bit around the role of alternatives and how it can play usefulness into portfolios. Yep. Okay. And so a lot of the focus, obviously, from an institutional perspective, has been into alternatives over time. We haven't been able to allocate as much into advised portfolios. But kind of we're starting to get a lot more into that space. Clearly, private credit has kind of been an answer for many around alternatives, but it's a lot broader than private markets as well. And so, first question I want to start off is just get a bit of a current state of alternatives in your portfolios. So what are you investing in and why, and what are you looking for them to do within portfolios? Stuart, I might start with you, thanks.
Thanks, David. So we manage the full range of portfolios at AMP because we manage the super fund, managed funds, and also managed accounts. And the role that alternatives play in each of those is really a function of the time frame of the portfolios. So if you have something like a super fund, the investment horizon is 30, 40 years. And so that's where we have our highest allocation to private market assets and alternatives. And these tend to be things like direct infrastructure, that's sort of 4 to 5% allocation, direct property and private equity, they're both sort of 2 to 3%, and then private credit, which gets all the discussion and all the focus is sitting there at 2%. So it's not a huge part of the portfolio that we blended in with other types of credit as well. In the managed funds like the North Professional Series, because investors can come in and out as they wish, we don't hold those very long multi-decade assets, and so we focus there on private credit, again at around 2%. And then in the managed portfolio space, it's a different world, and one that you need to think about differently because some of those will be people who are just using a low-cost index option. They're sort of growing their wealth stage, but also you will have some very large, maybe multi-generational money there, and you can really be thinking about how you might want to start putting sort of your longer-term private market assets into those portfolios.
Right. I'll start off in our group. We're quite fortunate in that we have two areas. We have a managed discretionary account as opposed to a managed account. So that is run under retail. And for us, when we look at that retail managed discretionary account, we do run those on platforms. So they're IDPS and public office super. So we have the traditional issues in there, which is around retail disclosure you need, and it's around the liquidity requirements, especially within public office super. We went down a different route probably a decade ago, which was we wanted alts in those portfolios. So we constructed alts programs. We constructed a defensive and a growth alts program. They run on a balanced portfolio, so a 60-40 portfolio. They're running at about 15% of that portfolio. And they are within a PDS structure. They're fully liquid at the PDS structure, but there's complexities in constructing those. So that's the one area. We then run a lot of family office, not-for-profit money. That is much more under an OCIO service. A little bit of it is on IDPS, but often it's non-custody. There we would see up to about 40%. And that 40% that we run typically would be across alts, various areas within alts. So maybe it's just worth sort of saying as well, when we look at alts and private assets, alts we typically look at in sort of a private equity, private credit, an opportunistic sleeve, an infrastructure sleeve. Those are the sort of sleeves we look at. However, sometimes we will use private assets within the standard fixed income sleeve as well. So we would run a fund in there where we would have, let's say, JP Morgan or someone running the core for that fund, and then we'd have a satellite in that fund, which might be Schenkman or something like that. So that's really the way we do it. Two different ways of doing it, just depending on the client and obviously the how we have to manage liquidity and disclosure.
Yeah, absolutely. So I think similar to Stuart, we run super diversified funds and SMAs, and I think that evolution that super's had more private credit, private infrastructure, private property, a bit of private equity. Diversified funds have had a bit of private property and infrastructure, and then recently with the SMAs, what we've been working on is building out a private markets SMA that is monthly liquid or PDS. I think there's two angles to this. So for the alternatives, we think of it in two different lenses. So the first is the private exposure, the illiquid exposure. We've gone through that. I think the second is around thinking about what can we use in the portfolio to provide protection for equity/bond downside. So that worry that was being talked about before, where the 10-year bond yield goes to 5.5, equity markets fall. And I think there are a couple of interesting options. I mean, the most important one that we use in both the diversified funds and the super product is actually long volatility managers. So actively going out and finding managers that smartly try and play that long volatility and give you that tail risk. The other one that we're doing quite a bit of work on globally has been cross-asset trends. So sort of your CTA style manager that we think provides quite a nice alternative to using government bonds as a diversifier for those scenarios.
Okay, we started touching on this, but kind of obviously managed accounts find it difficult to get into some of those less liquid kind of products. I know me and plenty of my platform colleagues are working on solving that and looking to kind of bring out either wholesale and or retail kind of solutions. And I know we're not far away from pulling one together. What do you make on that focus on illiquid assets in? I'll start with advised portfolios, but also then flowing through into managed accounts. Is there too much focus on trying to capture that illiquidity premium?
I think there's a lot of focus on private credit right now, especially Australian private credit. I think there is a lot of opportunities globally. More broadly, I think the illiquid exposure makes a lot of sense. And the key thing is, for your end advisor or your end investor that's looking to get exposure to the productive nature of the economy, the listed market is increasingly small compared to the private market. And so being able to get that illiquid exposure, that private equity, secondaries, whatever flavor it has, I think has a lot of benefit. And there's been probably more papers than were needed to write about the illiquidity premium. But from our view, we do think that it does exist. You do get compensated for taking on that illiquidity, and for clients that can do it, I think it's a really clever and good approach.
Go.
Yeah, so to keep the theme going, if you are concerned about basement or just want good, solid long-term returns, then direct property and direct infrastructure tend to have cash flows that are linked to inflation, so you do get some protection through those. The one that really concerns me is private equity. We're seeing a lot more regulated focus on valuations and timely valuations, and one of the great attractions of private market assets is their volatility laundering characteristics. And if the situation changes and trustees and responsible entities actually feel like they're obliged to mark their private equity holdings to market every time you get a 10% downdraft in equities, then suddenly you have an asset that has a correlation of 1 in down markets and 0 in up markets, and this is not the diversifier you were looking for.
Yeah, so broadly, I would agree with what you guys are saying. I think for us, there's nuances though in some of the private assets. So if we're looking at PE, our preference at the moment would be to look instead of at the long dated PE funds, because I think they just haven't performed. They haven't delivered on what we expected. Also, if you want vintage diversification, you're locked up for 20 years plus. But there are ways when you can look at some of the crossovers of accessing some of the late stage privates. And I think, being able to do that, and also in some of the co-invest where you've got later stage, that's a focus of us, which is just a bit more nuanced. But otherwise, 100% agree with you.
If we keep going up the curve into the institutional market, one of the constraints, if you like, is around the performance test. How does that impact on your thinking around what you can bring down from institutional into managed accounts and wholesale investing, given that has such an important
constraint, if you like, around how you invest. Alex, do you want to start?
Yeah, so I mean, the performance test takes up a lot of people's time and thinking. I think more broadly though, when we're thinking about bringing those wholesale solutions, it's less the performance test and more the institutional knowledge. So I think that one important point that both guys have made is, there are risks around these assets, and the most important thing is really doing very diligent manager selection. We've been doing that sort of stuff for 60 years. And so I think it's just bringing best of breed. The performance test is kind of an aside, and it's really about bringing the best solutions to market.
Yeah, I would agree. On the performance test in our portfolios, when in the construction of portfolios, the only time that we really take it into account is if we're running trustee-directed portfolios, so they fall under the performance test. It is especially hard in the alts bucket because, as you would know, the way APRA looks at the alts bucket and the benchmarks that they use for those are not aligned necessarily with the benchmarks of actual alts. However, for the other portfolios, we much prefer to take exactly what you said, which is getting to a point where we can take the institutional know-how onto select managers, the implementation, the operational due diligence, valuations, those sorts of things. Those are the sorts of things we want to bring down, not necessarily the performance test.
I was hoping I could go an hour of my day without thinking about the performance test. This again is a negative for private equity because you're benchmarked to listed equities. That's great for you in the short times when the equity market's going down because your private equity perhaps holds up its value, but after that turning point, you might end up 20-25% behind because you're still getting down marks coming through for your private equity as the listed market is off to the races. More generally, if we sort of think about liquid alternatives, we want to make sure that however you construct your liquid alternatives portfolio, it's able to do a good job relative to the performance tests alternatives benchmark, which is sort of typically 50-50 equities bonds.
One of the other issues we face a lot in the retail space is costs and fees. How do you think about all of that into the portfolio? I mean, normally the true investment house says, well, after fees is what matters, but we know there's a little bit of intermediary influence in that cost selection. So how does that impact on your thinking about where you end up allocating and what you're thinking about alts?
So in everything that you do, it's an economic decision. It's a payoff. So you have effectively a fee budget and an active risk budget, and then you just work out what is the best way to spend that over your entire portfolio, given the objectives that you're targeting.
I think from our side, when we're looking at the costs, when we're looking at the retail portfolios, you need to also understand the cost of the feeder funds from an RG97 point of view. That's super critical for advisors and clients. And you could say, well, look, we've got phenomenal performance and my fees are 5% because the performance fees have been so high. That's actually incredibly difficult for advisors to deal with and for clients. So we are very focused on that and how do we manage it? Now, there's not a lot you can necessarily do with it, but it is a key function for us. When it comes to our portfolios that are run for large families, not-for-profits, there we have an extremely strong focus. Our focus on there is actually running co-investment programs. So and there's a couple of people, Stepstone do it, we use Grosvenor. Those co-investment programs, pretty good. The main reason you run them is for price, but you'll run them as well because you get diversification at the GP or the sponsor level. You'll get diversification over various vintages. If you're in PE, private credit, and that's maybe a little bit different. But in there, that's just about cost. And those, we want to be at the same program level as a CalPERS or a Texas Teachers or Singapore Investment Corp. That's where we want to sit. And typically those programs will give you the best managers, the top quartile managers, and you'll run that at about 1 in 10, compared to if you're running those managers, and that's including a feeder. If you're running those same managers with a feeder, you're probably well over 3 in 20. So that focus is there, but you can't do it in the retail world. It's just not, the liquidity is not there. There's too big a liquidity mismatch.
Yeah, I think both guys have covered most of it. So for us, it's really about modeling out after fee returns. And I think also really being clear when you are modeling out, especially private equity, where you have the 2 in 20 or 1 in 10, whatever it is, with the carried interest, really modeling out what those fees will look like over the lifetime of your investment and being really crystal clear, both for our institutional funds and also for the retail funds that we're looking at, to make sure that we're very upfront and we're very aware of what the fee structures will look like under different scenarios.
If we keep focus onto the retail space, we've spoken around institutions and endowments liking, 30, 40% allocations into into this kind of space. Clearly, though, the super trustees, particularly given some heightened investment governance focus at the moment, is not quite willing to go to that kind of level. So, a lot of talk around holding limits and where do you end up? What's the right allocation in a retail portfolio? And given the liquidity mismatch, it's a really different beast to be able to run that as a retail managed account. So where do we start thinking about in terms of allocations in those managed accounts?
Okay, so we're running a managed discretionary account. So that's a little bit easier than running a managed account. But our allocations, really, when we're getting to there, they're probably about half of what we'd see in that the not-for-profit family office sort of space. And we've had to tailor build them. So we've had to build them into funds that a number of the guys, whether it's an EQT or it's a trustee of a BT or whatever it is, that they will actually approve those. It's important to understand what their requirements are as well. What are their legislative requirements? What are they trying to solve for? Whether it's paying out a death benefit, whether it's hardship, etc. So we have found that we can put private assets within certain fund structures, because the fund structure, especially if you've got hundreds and hundreds of millions in there. So our hedge fund program would run with about 800 million in there. Some of the other ones, fixed income, would run with several hundred million. So you can put private assets in there. So if you look, we're fortunate that if you look at our retail clients, they would probably have access to alts and private assets that are stretching above sort of 15 to 20%.
Okay, so I think alternatives broadly for retail, we have kind of hedge funds, long volatility. You want to have pretty small because it's a tail risk, right? It's a tail risk hedger. Hedge funds, kind of that 5% range. And then for privates, we've been doing quite a bit of modeling on this. And I think around that 10 to 15% is probably the max. And that's a nice trade-off of you are giving up some liquidity for clients and you don't know what's going to come around the corner. But you do get the benefit of, if you imagine the efficient frontier, you move up into the left. And so that 10 to 15 gives you enough of that boost without taking on, excessive liquid exposure.
Okay, and if we start talking a bit more to the future, we've spoken a lot about the structure and some of the constraints and how they're starting to be solved and how you think about putting them into portfolios. But what's going to be different in 5 or 10 years' time around the alternative space? Because it's clearly going to evolve a little bit as we see rapid enhancements. Stuart?
Yeah, I think that the alternatives allocation in managed accounts will look a lot like Alex described it. I think building on that, so I 100% agree on having a long volatility strategy and trend following, or there's some sort of cheap, systematic alpha strategy there that can perform well in up and down markets, but also sort of continuing the theme from before, an allocation to gold, whether or not that's a passive or actively managed, and also, of course, Bitcoin, because we are thinking beyond private markets and new ideas here. We like both of those assets. Gold, you can look at who's buying it right now. It's mainly the central banks, and as well as reducing their sanctions risk and reducing their US dollar exposure, they're also shortening their interest rate duration and improving the inflation hedging characteristics of their portfolios, which probably speaks quite loudly as to where they think the inflation trajectory is going. And then other good things about gold is it's a dominant player in a duopoly and it never misses on earnings. So these are all good characteristics. But we also like the other member of that duopoly, which is Bitcoin as an emerging store of value asset.
Well, I think from our side, we would see the privates alt space being very, very different. From a perspective of, if you think about the secondaries market in equities today, it's 100 around the world, 127, 130 trillion. The secondaries market that we see today in private assets, whether it's PE, private credit, etc., that market is nascent. And a lot of it started off because they were hard to sell assets that were non-performing, etc. I think the biggest change we will see is those markets coming of age and being able to access them in ways that are going to be much broader and simpler to access. So that would be my expectation, is that we would actually be able to use them in retail type portfolios. There will be better access. There's some things that have to be solved for that. Some of these have limits on the type of clients that can go in. that there's a liquidity potential mismatch. So we've seen some people list, private equity and things like that, and you end up with a mismatch and you end up with a discount, trading at a discount to NAV. So some of the things have to be solved, but I would expect that's what we would see. And there's such a volume of these assets and they're growing at such a volume, it makes sense that that happens.
I think they're on the private credit side, I think Australian standards will move more to American and global standards where they've been doing this for 30 years. So I think that's a really good thing for the end investor. I think the access to private markets will just keep expanding. I think there are still roles for those listed, and I think the worry about debasement and treasuries, etc. I think that allocation will increase across managed accounts. One thing that makes me nervous, I don't know, has anyone seen the lines at ABC Bullion in Martin Place? I just walked past before with like 70-meter lines. I'm not sure what that means for the near term, but I think that general trend will continue, and then just more access to private markets will come through.
Very good. I might open to the floor. Are there any burning questions? I know that alts is clearly a lot of focus, but
sorry, the question was, how do you define a defensive alt versus a growth alt? Is it to do with chance of loss, max drawdown? Is it a debt security or an equity exposure? Because you could say private debt since it's the flavor of the month, but you could have venture debt versus securitized property debt versus thing. Yeah, so just how you guys sort of break it out. So I think that's what I'm trying to do in our portfolios is there's alts, but they live in different places with different attributes.
I'm happy to go first if you want me to go first. I think from our perspective, we do run in retail both the defensive and growth alts. You've got the definitions or the accepted definitions from APRA and that, what your benchmarks in those are. Typically, though, for us, it's why are we using these alts and what are they trying to do? For us, when we define the mandate for those, and your mandate flows back into the capital market assumptions that flow back into your strategic asset allocation and then impact your tactical asset allocation. Typically, what we would see is we would expect lower volatility, so dampened volatility. So we would expect a return on our growth odds somewhere around about the 7% mark, maybe 8% mark, but with a vol about half of the MSCI equity. Whereas and then other characteristics as well, but the vol, and these are publicly available, so you can have a look at them. The vol, we would expect on the defensive alts, more correlation benefits in there as well. When you have big dislocations, we would probably expect about 4 to 5% returns there, and vol that's sitting at 2.5%.
Other questions? I've got a question about the sort of manager selection process for any one of the three of you. In listed markets, we're seeing the contest between passive strategies and or systematic strategies and active management. That doesn't seem obviously the case in the sort of alts that we're talking about here. So to talk a little about the sort of manager selection process and how you manage, what is the last refuge of the active managers?
For us, we're going to be using specialized teams to select the managers. So we have specialists for equities and fixed income, alternatives, private markets in each of those. So we have someone who knows the full range of managers, knows their histories. And so if you're looking at sort of private credit assets or something, you don't want some people who just come out of a bank or a credit fund. You actually want to see people who've got extensive experience doing workouts when loans go bad, because it's possible that you won't need that expertise soon.
I would just add a couple of things, so not so much on the selection, because that we use absolutely specialist teams to do that, and we would actually use external teams as well. But probably some of the things that I would look out for there is, one, the dispersion between the top and the bottom managers is huge, and especially in volatile times. So if you look through the GFC, you look through the 2000, the dispersion actually blew out on between the top quartile and bottom quartile. The other thing that is, especially in PE, quite difficult to get one's head around is the use of IRR. You know, it is extremely susceptible to being manipulated. It's not the same depending on the length, whether they're using some sort of call structure or something to mitigate their call structure, a line of credit or something like that. So we tend to prefer looking at sort of the sort of multiple on, so the MOIC, those sort of things, which sort of give you a much better sense of how you compare those managers. I would just watch out on IRR. It's not a great, it's very susceptible to being manipulated.
I think the manager selection piece is kind of, you know, specialist teams, etc. I think the other bit that is really important is looking at legal reviews and making sure that you've got a legal team. So where you have legal, both internal and external, that would do reviews of any fund document, offer document, to make sure that everything is above board and in line with what we would expect. But I think to Kieran's point about the variability, and I've done a shameless plug for Russell, so I'll give a plug to JP Morgan, who do some great work. They got their guide to alternatives has a really nice chart on the dispersion of returns for private assets versus public. Private equity dispersion is bigger than listed equity. Private credit is bigger than listed credit. So this is really a really important part of the process.
Yeah. I'd also add, make sure you do your due diligence on the RE, not just the portfolio management team.
Yeah, and ops due diligence comes in hugely in these things as well. Operations can play these guys up, and I think the trustees will start getting more into that as well. You know, if the ops due diligence, not just the due diligence on the manager.
Yeah, the regulator's hot to trot on all of us for that. I'll give
Yeah.
you that tip.
Right.
So look, I think that rounds things out. No burning questions to finish off.
No,
Look, clearly a interesting space to think a lot more about alts, a challenge to managed accounts. We've not been there deeply yet, but I think me and most of my platform colleagues are doing the heavy lifting to try and make sure that comes together. Asset managers obviously bringing more and more product to help us out as well. So yeah, deep thought. But please join me in thanking Kieran, Alex and Stuart.
Thank you so much.